The people who print the world's money are dumping it. Right now, the architects of our financial system are quietly swapping their paper for gold, and they aren't telling you why. Read that again. If the baker won't eat his own bread, you should probably stop buying the sandwiches. Right now, the world's central banks are acting like a homeowner who smells gas in the basement at 3 a.m. They aren't screaming fire yet because they don't want a stampede. Instead, they are quietly moving their family heirlooms into the backyard, while the rest of us are asleep in the master bedroom. We aren't talking about fringe investors or gold bugs in tinfoil hats. We are talking about the Federal Reserve, the People's Bank of China, and the European Central Bank. They are frantically grabbing every ounce of gold they can find with a level of desperation we haven't seen in generations. The mystery isn't that they are buying gold. It's the scale and the speed at which they are buying it. In 2023, central banks vacuumed up 1,037 tons of gold. To put that in perspective, that's nearly double the 10-year average. China alone has increased its reserves for 18 consecutive months. Even nations like Poland and Turkey, countries that couldn't be more different economically, are sprinting toward the same finish line. The question no one is asking on the evening news is, why now? The S&P 500 is hitting record highs. The Magnificent Seven tech giants are valued more than the GDP of entire continents. On the surface, the money printer era looks like a total success. But if the system is as robust and resilient as the talking heads claim, why are the architects of that system hoarding the ultimate "I don't trust you" asset? They know something the retail investor doesn't. They are preparing for a sequel to a movie we all thought was over. To solve the mystery, we have to look at the Nifty 50 era of the early 1970s. Back then, the market was obsessed with 50 blue-chip stocks: Disney, McDonald's, Xerox. People thought they were one-decision stocks: buy them and never sell. Sound familiar? It's the 1970s version of the AI hype we see today. But behind the scenes, the foundation was rotting. Since the end of World War II, the world operated on the Bretton Woods system, where the dollar was king because it was backed by gold. But the US was spending too much on wars and social programs. They were printing more dollars than they had gold to back them up. In August 1971, President Nixon went on TV and temporarily suspended the dollar's link to gold. He essentially told the world, "Our currency isn't backed by metal anymore. The full faith and credit of the US government backs it." Translation? Trust me, bro. For 50 years, that trust me, bro economy worked because the US was the only game in town. But liquidity is like a flood. It feels great when it fills your pool, but it's terrifying when it starts rising into your living room. The central banks remember what happened next in the 70s. A decade of stagflation, 14% interest rates, and a 90% drop in the purchasing power of the dollar. They see the 1971 sequel starting, and this time they don't want to be caught holding paper. But trust me, this only works as long as the math adds up. And today, the math is starting to look like a nightmare. Let's look at the villain of our story, the data. First, look at the US dollar's share of global reserves. In 2000, it was 70%. Today, it's plummeted to 58%. The world is de-dollarizing, not because they hate America, but because they are terrified of the math. We are currently adding $1 trillion to the national debt every 100 days. That's like someone who chugged a Four Loko at 3 a.m. and decided to go on a shopping spree with a maxed-out credit card. Central banks see this and realize that money printer go brr has reached its logical limit. When you print the menu, you don't create more food. You just make the prices on the menu higher. Corporate PE ratios, the price you pay for $1 of earnings, are at levels that make 1929 look like a clearance sale at Walmart. The S&P 500 is currently 36% concentrated in just 7 stocks. If those 7 stocks sneeze, the entire global economy catches pneumonia. Central banks are the ultimate insider traders. They aren't buying gold because they think it's going to go to the moon next week. The stock market. It doesn't move because a CEO tweeted or an algorithm glitched. It just exists, and that's its power. It doesn't care about earnings calls. It doesn't care about interest rate pivots. Let's connect the dots. Dot 1. The AI revolution is driving stock prices to the stratosphere. Dot 2. Inflation is sticky, meaning your grocery bill isn't going back to 2019 levels. Dot 3. Geopolitical tensions are at a 40-year high. When you put these together, you realize we are living in a monetary bunker moment. Central banks are building a floor under the system. If the digital economy, the penthouse, collapses, they want to make sure the physical assets, the foundation, are made of something that can't be deleted by a bank failure or an algorithm. They are hedging against the Magnificent Seven moment. They see the party is still blasting music, but they notice the host is already outside putting plywood over the windows. So, who benefits from this? It's the people who practice independent thinking. In a world where everyone is chasing the next 100x meme coin or AI startup, the person who understands why the banks are buying gold is the one who won't panic when the volatility hits. The beneficiaries are the risk managers, the people who realize that diversification isn't just owning 7 different tech stocks. It's owning assets that don't require a counterparty's promise to have value. If the bank shuts down, your gold doesn't care. If the power goes out, your gold doesn't care. So who loses? The losers are the complacent. If you are 100% indexed into a system that the banks themselves are de-risking from, you're essentially holding the bag for the people who designed the bag. The middle class usually loses in these transitions because they are the last to find out. They are told inflation is transitory and the economy is strong, while the people telling them those lies are quietly swapping their cash for bullion. Complacency in a high liquidity environment is the fastest way to get soaked when the tide goes out. And trust me, the tide always goes out. Now, I know what you're thinking. Is the world ending? Not necessarily, but the game is changing, and there are 3 ways this plays out. The soft landing, the 1940s route. Central banks continue a slow-motion pivot. We enter a decade of financial repression, where inflation stays at 4 to 5%, interest rates stay high, and the stock market goes sideways for 10 years. You don't crash, but you don't get rich either. The Great Bifurcation. The world splits into 2 financial blocks, the Paper West, USD Euro, and the Gold East, BRICS. This creates massive volatility as the 2 systems fight for dominance. Gold becomes the neutral currency used to settle trades between enemies. The Reset, the 1971 sequel. A new global agreement, a Bretton Woods 2.0, where gold is officially brought back to the table to stabilize global trust. This would cause an overnight revaluation of everything you own. I'm not here to tell you to go out and buy a gold bar today. I'm not a financial advisor. I'm just a storyteller. But here is the lesson history teaches us. In a world of infinite digital currency, the only thing that retains value is what cannot be printed into existence. The central banks aren't buying gold because they are scared of the future. They are buying gold because they understand the past. They know that trust is the most fragile commodity in the world, and once it's gone, you can't print more of it. Don't trade on panic, and don't buy into the hype. Just watch what the big money does, not what it says, because gold is the only money that has never required an apology from a politician. If you enjoyed this breakdown, subscribe to Zariah Finance. Every week, we uncover the stories behind the world's biggest financial headlines. Stay curious, stay skeptical, and keep your eyes on the foundation.